As we'll see in this lesson, the primary market has to do with an issuer raising capital by offering stocks or bonds, for example, to investors for the very first time. We'll talk about different types of offerings and different types of commitments from the underwriters, the investment bankers. So again, investment banking, underwriting, what is that? It's just broker-dealers who raise capital for issuers of securities. They help companies go public, they help them sell bonds, they do the same thing for state governments, etc. This process, as we see, is regulated by the Securities Act of '33. It has a very narrow focus of requiring full disclosure of all material facts. So a lot of companies don't want that. They stay private. But if you want to go public, you got to tell the whole world your business, the details of what could go wrong, all the risks involved, all the financial results for recent years, etc. And unless you have an exemption, as an issuer, you're probably going to have to register with the SEC. They're going to slow you down. They're going to make you provide this full disclosure. Usually you have to rewrite your registration statement several times until you get it to where the SEC says, okay, you can now sell these securities on this date. But not until. So conceptually, a private company such as Frank and Emma's, which is fictitious as far as I know, uses their local banker for a line of credit. But if they want to go public, they use an investment banker, a group of broker-dealers, or if it's a small offer, it could just be one broker-dealer. But for the big ones, it's a group of broker-dealers who are going to take on Frank and Emma's as an underwriting client, and then they're going to find investors who want to provide money to Frank and Emma's in exchange for the securities. And the investment bankers take a percentage. So they're raising money for their client by finding other people's money, and then they're taking a percentage. If the investor reads the prospectus, the registration statement, likes what they see, maybe they'll buy stock. What will they receive? Nobody knows. There's no stated rate of return. It's just an ownership position. You want to own a piece of Frank and Emma's future profits? If so, buy this common stock. You should only invest the money you could afford to lose. Many people have lost most or all of their money doing this. But there's unlimited upside. There's no limit to the profitability of Frank and Emma's, so there's no limit to the upside of the common stock. Or a bond offering. Now the underwriters are finding fixed income investors. They look at the offering document. They like the rate of return versus the risk. So maybe they buy these bonds, which in our example are 4%. If we buy $1 million of these Frank and Emma's Fruit Pies bonds, we get 4% of $1 million, which is 40 grand a year in interest income. That'll be in 2 payments of 20. And then with the last interest or income payment, the principal amount comes back, the $1 million. Unless Frank and Emma's goes bankrupt, which would not be fun. So the issuer through the underwriters, they file the registration statement, they go into the cooling off period. No advertising, can't take any money, can't finalize sales. You're going back and forth with the SEC, who is usually going to have to issue deficiency letters, and then you're going to rewrite the registration statement until you get it to where the SEC says, okay, here's your effective or release date. On that date, you can complete the transaction with investors. And then after that, it starts to trade. We're not talking about the trading of securities in this lesson. It's the primary offering of them. So during the cooling off period, we can take indications of interest if we're these underwriters. We have a preliminary prospectus that we deliver to anyone who gives us an indication of interest, which is a non-binding indication that I would maybe want to buy these, and probably this many shares. When we go back and forth with the SEC amending this registration statement, we have a preliminary prospectus, and then when we get to the phase where we get to the final prospectus, now we know the exact offering price and the date that it's going to happen. But during this period, we can't do any general advertising, but we can do a tombstone ad, like we see here. We had an expected price range of 108 to 135, which is interesting because I remember it went public at 85. So they must not have had quite as much demand as they thought here. But this is just a statement of basic fact. This many shares of this stock is going to be offered through these underwriters. These are the guys handling the deal. And then the bigger the font, the more shares they're committing to sell. But that's a lot of different broker-dealers. So broker-dealers are competitive businesses, but they all also have to do cooperative effort like this in order to trade securities on the secondary market, in order to bring them public on the primary market as well. So no promises of wealth here or any information about the company. Just this is an offering of stock. You can get more information. If we could blow the text up here, so you could get a prospectus from many of these broker dealers. So we've amended our registration statement maybe 6 or 7 times. We finally get it right, so to speak, and the SEC then gives us the release date. That's the date we can complete the transaction, settle it all up. And on that date, a final prospectus has to be delivered, which usually is just a very brief statement. So consider the preliminary prospectus plus this brief statement of fact to be the final. And it's usually just the offering price is exactly this. Everybody always pays the same offer price. And the release date is on this date. Are the underwriters putting their own capital at risk, or are they just acting on behalf of an issuer and doing their best? If the underwriters have money at risk, they're doing a principal transaction or they're doing a principal underwriting. For example, a firm commitment, we're going to raise X amount of money, and that means that we might even have to buy some of the unsold shares if it doesn't work out. Or a standby, which is really a firm commitment for a rights offer. The company's doing an additional offer of stock. They don't need an embarrassing headline that they couldn't even sell it. So, after making a bona fide offer to sell all the stock, one of the underwriters could buy what's left in a standby. So it's not much different from a firm commitment. But if we're doing a best efforts or one of the contingency offerings, as underwriters, we're just trying our best. In best efforts, the issuer will accept whatever we can raise through our best efforts. They won't cancel. They hope to raise 10. Maybe we only raised 8 million. Well, they lived with it. I kind of think that those don't happen too often. I could certainly see a contingency offering, though. All or none. Let's say the issuer needs at least 10 million, and if we find weak demand as underwriters, then the whole thing will just be canceled and people will get their money back. Mini-max is really almost the same thing. We have a minimum number, which might be 10 million, and then if there's extra demand, we'll allow the underwriters to sell up to maybe 12. So it's pretty hard to make that a hard question. They give you 2 numbers as a minimum and a maximum. The main thing, though, under any of those scenarios, the broker-dealers acting as underwriters are putting a lot of time into it, but they don't have to buy any unsold securities. That's a principal transaction or underwriting. The syndicate is the group of underwriters, like we saw, the bigger the font, and then they may have other broker-dealers who can help find customers, but the selling group of broker-dealers never has any money at risk. So the syndicate could, if it's a firm commitment or a standby principal. The selling group never would. And again, if it's just a contingency offering or a best efforts, that takes the syndicate off the hook as well. So that issuer must not be, hotly pursued by Wall Street. If it's a really major underwriting, it's probably going to be a firm commitment. And if there's a lot of demand, the issuer and the underwriters usually have a clause in their agreement that would allow the syndicate to sell even more shares up to this amount. And that's disclosed and explained in the registration statement. The green shoe clause. No idea why they call it that, or why I spent good time looking for that green shoe. Now this seems a little strange when you first hear about it, because it seems a lot like market manipulation. Well, it's the only form of market manipulation that I can think of, and it comes subject to a lot of rules. But only after the stock has been released through an IPO. Only now can one of the members, usually a managing underwriter, go out and try to support the price on the secondary market. So everybody who bought this IPO is taking on a huge risk that it could drop $10, $15 a share as soon as it starts trading. Well, there is at least a plan here to try to support the price on the secondary market. We have to explain this, called stabilization, in the prospectus. On the trading systems, it has to be clear that this is a stabilizing bid, and it's only a bid. It's not also an offer. It's buying interest. Also, you wouldn't be able to do it at all as an underwriter unless there were other market makers out there, and there usually are. But if there are independent market makers, not connected to your firm or this underwriting in any way, you can bid only as high as they're bidding. So there's more buying interest, but you're not jacking it up above what another market maker is willing to pay. So this is how underwritings can start to lose money, and that's all explained to the other underwriters as well, but it has to be explained to investors that the underwriters will go out and do that. This would actually protect you if you were buying the IPO to an extent. I mean, if it's a disastrous opening of trading, this is only going to have so much value. But you can't have 5 or 6 broker-dealers doing that. Only one firm is doing it. So primary market, the initial transaction where the issuer receives the proceeds, and then we have different types of offerings, stocks and bonds. It could be an IPO or an additional. And then what's the commitment of the underwriter? Are they going to buy unsold shares and act as a principal, or are they just going to do their best as an agent?